Hey guys, welcome back to my channel. My name is Andrea and here is where I teach all things online business and social media. Thank you so much for being here and let's get started. Today I am going to talk about something that I find so interesting. Most people might find it boring, but it's something that's super important to learn. Today we are going to continue our topic about investing. So this is going to be part 2. If you haven't seen part 1 already, be sure to go back and watch it. I'll put a link right up here in case you want to check it out. It's talking about all things that you need to get started with investing. So if you're here, that means that you're probably ready to start investing or you're just interested in what I have to say about investing. I just want to quickly remind you guys that I am not a financial advisor. This is simply what has worked for me and what I would recommend to my younger self if I could have. So I hope that you will take whatever I give here with a grain of salt, do your own research, and in fact, I'm gonna link some resources down below, which I also posted in part 1 of the investing series, just in case you want to dive deeper for yourself after watching and learning a little bit about investing. So there's a couple things before we get started. If you could please give this a like, be sure to subscribe. I really appreciate that. Thanks, guys. I am about to say something that might be a little bit controversial, but I believe that you are fully capable of managing your own finances without a financial advisor. I know you might have been told otherwise, but let me follow that with saying that if you prefer to have a financial advisor, that is totally your choice. But I believe that you are totally capable of managing your own finances. In fact, who in this earth is going to care as much about your money as you do, right? So I feel like you should have a basic, at least, understanding of how to manage your own finances. And I'm going to teach you a little bit about how you can get started with that. In fact, if you are having your finances managed by a financial advisor or an institution, then there's a lot of things that you're left in the dark about. And also one of them is, if you notice when you sign up for a 401k plan or anything like that, there's tons of paperwork and you don't really even know what's in there. So a lot of what's in there are a bunch of fees that you will never know about until you go to take out your retirement. And maybe it is just 1% or 1 to 4%, whatever it says. But 1 to 4% can actually add up to hundreds of thousands of dollars that these people are taking from your retirement fund. So that is why I say you should at least consider managing your own finances, because I believe you can. There are a few questions I suggest that you ask yourself before getting started. Everyone's situation is so different and unique that there's no one way of investing. So you have to ask yourself this question because there are many different ways of investing. Of course, there are other ways to invest than the stock market, such as real estate, but today I'm just going to talk about the stock market because real estate is a whole other side of investing. And to be honest, I know more about the stock market. We don't even have a house yet, so I'm not going to even go into real estate. But stock market, I know about. We are invested in the stock market, so that's what I'm sharing today. I would say one of the most important questions to ask yourself is how risk averse or how worried are you about having your money in a stock market? So if you're just getting started, maybe you only want to invest in ETF index funds, which allow you to diversify across many different companies. For example, if you're invested in an ETF index fund via the S&P 500, that automatically, when you invest into that, for example, one of the stocks that we invest in is called VOO, is an ETF index fund which follows the S&P 500. The S&P 500 is 500 companies. So when you invest in this stock, say right now it's about like $305 to invest in this stock. But say you invest in this stock, your money is automatically diversified across 500 companies. Yes, there are some stocks that are more heavily weighted, but it still diversifies your money and is proven to be a more safe investment than, say, investing in one stock or something like that. So that's an option. Okay, so this next example, even though I just said I didn't know much about real estate, is gonna be an example with real estate. So in real estate, you can either buy a home, fix it up, and sell it, so flipping a house and make a big chunk of money all at once, or you could invest in a property, get monthly income from the renters, and hold on to that property. Basically, in that scenario, you would be gaining money from the appreciation of the house and also from your renters versus just buying and then selling and making that profit. So it's similar with the stock market. So there are actually stocks that you can buy that are called blue chip companies. These are older, more reliable companies such as Coca-Cola, IBM. Even the one I mentioned earlier, some of the ETF index funds also pay dividends. So that's what I'm talking about right now. A dividend is when the company actually pays you on a quarterly basis a percentage of each stock that you are invested in. Each company varies, but this would be similar to the example that I just said about buying a house and getting money from the rent while it's also appreciating. So you still own this stock and its value continues to grow, but the companies also pay you a dividend. So it's small, but if you were to add up all of these stocks and you continue to invest in stocks that produce dividends, I actually know people that live off of what they make just off of stocks on dividends. So that's pretty cool as well. Typically, tech companies don't pay dividends because they are higher growth companies, so they're more focused on growing fast. Companies like Amazon, Tesla, Apple, these companies are not paying dividends because they are tech companies and are very focused on growing fast, and they are. So it really depends what stock you invest in. There's pluses and minuses to both. So we have both. We have some stocks that have dividends, and then we have some stocks that are just tech stocks that are growing in appreciation, as I was saying for the example with the houses. So we could sell those and make money off of our investment because they've grown, but those stocks are not paying us dividends. Either way, I highly suggest holding on to your stocks and not selling right away. Some people like to day trade or buy and sell stocks and try to time the market, but no one can really time the market, and you're more likely to actually lose money if you do this. So I highly suggest buying and holding. Whatever it is that you buy is more proven that you will have a better outcome that way. So I also wanted to quickly mention another reason why I recommend buying and holding instead of buying and selling quickly is because every time you make a sale, you're gonna have to pay taxes. So that's called capital gains tax, and you're gonna have to pay taxes on those sales. So that's another benefit of holding for the long term, is that you won't have to deal with that. Okay, let's move on. Let's get started talking about different investment accounts that you can have. So now I'm going to talk about the difference between a Roth IRA and an IRA, and I'm going to give actually an example that's pretty cool to see. There are pluses and minuses to both accounts, but my personal favorite is the Roth IRA. I think it's so amazing, and everyone needs to take advantage of this as soon as possible. If I were 18, I would beg myself to start investing already, but I'm not 18 anymore. But if you are 18, please take this advice. So a Roth IRA basically allows you to pay taxes now instead of paying taxes once that money has grown. So I'm about to show you an example, but say you start investing and contributing the maximum amount to your Roth IRA when you're 18. So you would put in $6,000, but that $6,000 is going to grow. Even if you didn't add any more money, that $6,000 is going to grow every single year until you want to take it out. So it's going to grow, and typically the stock market interest rate grows by about 7 to 10% every year. So if you put in $6,000, that $6,000 would grow by 7 to 10% every year. So do you want to pay taxes on the $6,000, or do you want to pay taxes when you go to take that money out after it's already grown? So that's the benefit of a Roth IRA, is that you can pay taxes now on the $6,000 and not have to pay taxes on the hundreds of thousands of dollars that it will turn into eventually. So that's amazing. Now, the opposite, or the other option that I mentioned, was just a traditional IRA account. Traditional IRAs can be good if you're trying to lower your taxes for the year. But as I said before, I personally highly recommend the Roth IRA. I would much prefer the Roth IRA over a traditional IRA because it just makes so much more sense, and you would save so much money in taxes in the long run. So that is the main difference. Now, there are some disadvantages to a Roth IRA. Unfortunately, nothing is perfect, right? So the disadvantages to the Roth IRA are that there are contribution limits and there are income limits. So once you start making a certain amount of money, you can no longer contribute to a Roth IRA, or you have to start phasing out your contributions. So you can only contribute less than $6,000 or nothing. So that's one of the benefits of starting if you're young. That's so good, because generally young people are not making $200,000 or more per year. So I'm also gonna link down below the chart that talks about contribution limits. It's on the IRS website, but basically they lay out everything, how much your adjusted gross income is. So basically between like what you make and the tax write-offs you have, in the end, your profit for the year is that you have to have less than $196,000 for 2020, something like that. So if you make more than that, you cannot continue contributing to your Roth IRA. So that's a disadvantage. But also another disadvantage is that you can only contribute up to $6,000, which is great. But if you have other money to invest, because technically if you watch my other video, you should know that you should be investing 15% of your yearly income. So generally that's more than $6,000. So what do you do with the rest of that, right? Okay, finally, even though there are a couple disadvantages, another great thing that the IRS does is they adjust the contribution limit according to inflation. So last year, the contribution limit was $5,500. That's for people that are under 50 years old. But this year, it was $6,000. So each year, I don't know if it's every single year, but the IRS does adjust the maximum contribution limit to the Roth IRA based off of inflation to account for it. So you're actually contributing the same amount every year based off of the adjusted inflation amount. So that's pretty cool. So if I haven't convinced you yet to start investing in a Roth IRA, do it now. Go do it. Go open an account. Anyone can do it. Anyone can do it. That's the coolest part. You don't need a financial advisor, as I told you, or anything like that. There are great websites, places like Schwab or Vanguard. Both of those places, you can actually open your own Roth IRA. It's very simple, and I highly recommend it. So finally, another benefit of the Roth IRA is time. The longer you have the money in an account, the more chances you have to grow that money with compound interest. So every single year, your investment is growing, whether or not you add more money. So if you just added $6,000 and didn't do anything, that money would still be growing. I actually created a chart to just give you a visual picture of this. So I am going to cut to the chart and give you guys a little example here. If you haven't noticed already, this video is longer than my other videos, and it took a lot longer to put this one together. Same with the chart. So if you don't mind giving a thumbs up, that would really help out the channel and show me that you're appreciating this content. And share this if you're learning a lot. If you think someone needs to learn this information, be sure to share with your friends. Thanks, guys. All right, let's take a look at how your money could grow in a Roth IRA. we're going to compare two people, one person starting at 18 versus one person starting at 28. Both people are going to retire at 60. This chart takes into account making an average of an 8% return on your investments each year and contributing the maximum amount each year as of 2020, which is $6,000. So I'm comparing person 1 who starts investing at 18 and stops at 28 versus someone who starts at 28 and continues to invest every year until they are 60. As you can see in this chart, the person who starts investing $6,000 per year at 18 and stopped contributing at 38 made $830,578 more money than the person who started investing at 28 and contributed the maximum amount every single year until the age of 60. This is the power that compound interest has, and I was only using an average of 8% growth. This can be up to 10% growth. In case you're wondering how I made these calculations, what I did is I started with $6,000, the initial investment, and then I multiplied that by 8%, which gave me the interest. For example, it gave me an interest of $480 off of $6,000. Then I added that to the initial investment, which gave us a balance of $6,480 made in the first year. From that, I then added on the next year's investment, which was another $6,000, assuming that the person contributed the maximum amount. That then gave us $12,480. I then took that number, multiplied it by 8%. That gave us $998 of interest made. And then I added that $998 to the $12,480, giving us a balance of $13,478. I then continued to add the maximum contribution amount of $6,000 as of 2020. And I continued this for each case. For person 1, I continued up until 38 years. And for person 2, I continued up until 60 years with the maximum contribution being added. And the interest just continues to grow as we add more and more money. So in the end, person 1 ends up with $1,776,338, and person 2 ends up with $830,578. And that is the impact that compound interest has over time, which is so cool. Wow, isn't that crazy? Looking at that chart makes me so excited every time. How crazy is that? If you haven't noticed, this is why it is so important to buy and hold your investments, and I totally stand by that. Even though there will always be down years, which they call bear markets, there will always be bull markets as well, which is the up years, and you don't want to miss out on the times that the market corrects, and usually they have the highest corrections after the lowest drops. So you're never able to predict the market. You just have to leave your money no matter what happens. The US economy has always recovered, and that is why I highly suggest leaving your money in there. Along with leaving your money in your investments in your account, I highly suggest just continuing to add to your investments monthly, even if you can, in good and bad times, because it will equal out over time. In fact, the bad times are actually some of the best times if you have money to invest, because everything's on sale. You get all these stocks at the lowest prices, and then when the market bounces back up, you get to take advantage of the difference that you made just because you invested in the bad times. So the bad times can actually be the best time. Finally, I wanted to talk about what you can do if you are able to max out your Roth IRA every year, the $6,000 contribution, and you still need a place to invest your money. This really depends on if you are self-employed or if you're an employee. So if you're an employee, I would highly suggest seeing if your company is able to match your 401k contributions, because if they are, you should definitely take advantage of that. If they are able to match your contributions, definitely contribute as much as you can there, and then the rest you should contribute to a Roth IRA from the remainder of that 15%. So as I said in my first video about planning for investing, you should be investing about 15% of your monthly income to your investments, investing to your investments. So that is something to take into account. So say that your company matches up to 6% of your monthly investments. So then the rest you would put and open your own Roth IRA and have it there. So that's just a suggestion. Additionally, if you are self-employed, I know more about this because I'm self-employed as well. Me and my husband are. And so what's really cool is that if you have your own business, you can open up a 401k with a Roth component. The 401k Roth is so amazing, and it's a great opportunity for people who are self-employed because it basically allows you to pay money on the seed, as what I said before. So you're paying money on your investment now instead of when you take the money out later. But the cool thing about this is that the contribution limit for your 401k Roth is $19,500. So it's a much higher contribution limit. So that gives you a ton of space to be able to invest more money without paying taxes later down the road once you're ready to take out that investment. So definitely take advantage of that if you are self-employed, and be sure to call your investment account if you need help setting that up, and you can just ask to open a 401k Roth, and you will be very happy down the line that you did that. That was a lot. I hope that you guys enjoyed this video, that you learned a lot from this, that you could take something out of it. And if you did, be sure to like and subscribe, and let me know in the comments down below if there's any other topics that I can cover to help you guys out. And also be sure to check out the resources that I pinned down below so that you can dive into this topic deeper if you'd like to learn more. Thanks so much, guys, and see you next time. Bye.